Okay, hello everyone. So, a bit of technical caused me to delay by 10 minutes, but anyway, as promised, we are here with our first webinar. So, the basic, like the first one was the zeros webinar, and this is the second actually. And this webinar is on basics of backtesting. So, as we have discussed in our previous webinar, that why backtesting is important for any trading strategy. So without wasting any much time, we will directly go to backtesting basics and steps that we all need to follow to complete a backtesting. So first I will share you the things, the prerequisites that we need to have before going deep into backtesting, and then how to do or how to complete, and what are the softwares, what are the like technical requirements to do the backtesting. Okay. So starting with, we will first of all go for hypothesis formation. Okay, so hypothesis is kind of a basic, your hunch or whatever your gut feeling that might work in the market. Okay, so basically if you play some random trades, it might go up, it might go down, it might go in your favor or against you with equal probability, just let's say. Okay, so maybe like you may be following a very good trading strategy and it may be having a very good probability. Okay, and that might have some good edge. Let's say like you are hitting 80% of your total trades into profit, so that's a very good trading strategy. But even if like if you don't have any trading strategy and you are just randomly placing the orders, okay, so what is the kind of probability that you have for hitting your profits or losses? So let's say like it might go in your favor or it might go against your direction that you predicted. So that's the probability of 50-50. Okay. So once you start following this trading algorithm of randomly placing the trades, you are not going to make any money. And on top of that, you are going to lose money in commissions and trades on brokerages. Okay. So the thing is that you need to have some trading strategy that will generate you a positive income so that you can get profit after taking out all the commissions and brokerages for the broking houses and government and etc., so that you can take out your profit and you can increase your account. Okay, so that's why a trading strategy is needed. So there are many traders who trade on discretionary basis. We do not have any trading strategy, who just see the market and predict where the market is going to go. And they have a very different kind of like trading style, and they discuss with other traders, they have their own kind of like, but they have some kind of like strategy, maybe that they don't want to quantify, or maybe like quantifying that strategy is not feasible. Okay, so let's say you are kind of like a very astrological person, astrology believing person. Okay, and you gauge the movement of planets and other celestial bodies, and then you start taking trades. Okay, so this can be quantified, but you don't want to quantify. You have a different charting software for your astrological advancement movements, and then you correlate that with the market. Okay, so there is something called Gann trading style. So this is kind of like trading style that uses this kind of approaches. So just to let you know that this kind of systems also exist, and historically, I don't know, I have never tested it out, but yeah, there are many believers of it that say that this kind of like trading strategy also give them a good return. So good for them. So as long as someone is or anyone is making money, that's all, that's the end game, that's the plan of it. Okay, so yeah, if you want to follow some astrological system, If it makes money, that's good. If you want to follow some kind of like different altogether style and that makes money, that is good. And if you want to follow a very high tech system and if it doesn't make money, then that's not good. Okay. So basically in quantitative finance, okay, you have to make models, you have to generate some models, you have to back test it, you have to like forward test it, and then you have to deploy it so that it makes you a consistent revenue source. And that revenue source should be greater than the brokerages and taxes taken subtracted by. Okay. So in case if it is not greater, then the trading strategy will fail. So yeah, so just an introduction about us. We are from Beta Quants Private Limited, and we are into technical education on quantitative finance. So if you can go to our site and check out our courses, it would be a good head start for you if you want to approach markets in a systematic and technical way. Okay. So there are many unsystematic ways that provide that are kind of like guaranteed to work in the markets, but that's up to you. Not dis- I'm not kind of any kind of like an advisor here. Okay. So let's start our backtesting. So I'll just start with the prerequisite. Okay. So the first and foremost prerequisite is you to have a hypothesis. Okay. So I opened this chart of Nifty. Okay, I'll just sign it up. Yeah. So here we have this chart of Nifty. Now, how do we generate a hypothesis? So there are many ways of generating. Just by looking at it, we can like have some kind of like a line formation that okay, the Nifty will bounce up whenever like it hits its support or it hits like its resistance. I'm not very good at drawing, so yeah, you can pardon me on that one. So this is some kind of like crude channel that I have drawn, and yeah, and hypothesis can be as simple as that a line, you can draw a line and the script will bounce back or bounce between these two lines, and then you can test it out. Okay. Testing out technically may be a bit difficult for this kind of like trading strategy, but it is possible. Everything is possible, and when you get deep into it, it's just unfamiliar. Okay. So I'm here to get you unfamiliar with this topic. Okay. There are many technical indicators. So what are technical indicators? So what do we have here in this chart? We have a candlestick chart. And candlestick chart, as you would have known, has four data points, and if you can add volume underlying, you can also add volume also. Okay, so here I will not take volume. Here I will just play with OHLC data. So OHLC data is open, high, low, and close data. So the first one is we have fixed our universe. We are going to backtest it only on Nifty. You can expand this to other indexes, Nifty, Bank Nifty. You can expand it to stocks, all the stocks under Nifty or all the stocks under Bank Nifty or all the futures and option stocks or the stocks that are completely in universe, maybe let's say like 4,000 stocks. That's up to you. Now hypothesis, we need to go for data collection. No, we need to like specify the time frame. Okay. So that's also something you need to create on the first end itself. Then you can modify it later, of course, but you need to like have some starting point. So this OHLC data that you can see on the screen is on time frame of 1 day. So if I can like make it more granular, okay, I can go up to like let's say 3 hours. So this is the Nifty's chart on 3 hour data frame. So you can see that whatever our line was, it kind of like got a bit of elongated because the 1 day time frame went into 3 hours. So number of candles increased. We can also go up for 1 hour. We can also go for, let's say, 5 minutes. Yeah. We can also go for, I don't know, like we have 15 seconds also. Now I don't want to trade in 15 seconds. That will be basically scalping. Okay. So, and also there are many difficulties when you start going into 15 minutes or 15 seconds or like less than 1 minute of time frame. Okay. So as we discussed in the last webinar, there are issues of latency, there are issues of getting the data. So these are the hurdles that you need to consider while selecting your parameters. Okay. So let's start noting it down, whatever we have discussed till now. Yeah. So the first one is hypothesis formation. The second one will be the universe selection. Third will be time frame decision. Okay, we'll keep on discussing and we'll keep on adding this kind of points. Now, once we have identified these points, so let's take a very simple one. Let me remove this. So you must have known about some technical indicators. Okay, so let me add one technical indicator. So here you can see there are many technical indicators for you to use. So and all these technical indicators use some combinations of the OHLC data or the volume data. So there are kind of like only 5 data points that you can use, and you can make as many kind of like signals that can give you buy and sell signals. So how does it work? Let me just add one momentum indicator. So these indicators are kind of like classified into various categories. So one of them is momentum indicator. So momentum is kind of like when a stock starts moving up, it will keep on moving up for some period of time. And there are some indicators that will indicate this movement. Okay? And those indicators are called momentum indicators. So basically they are kind of like exponential moving averages, simple moving averages, and other things. Okay? There are also volatility indicators, there are volume indicators, and other things. Okay, so moving average. So we have moving average exponential. Show. Okay, so here it is. We have all the moving averages with same parameters, so it will not show different. So let me change it out. Let me change one of them. Yeah. So now on the chart we have two moving averages. So first of all, let's go with just a single moving average, and then we'll go with multiple moving averages. Okay. So as you can see, just by looking at it, I can have a hypothesis that whenever the price crosses the moving average, this 9 EMA, exponential moving averages, it will keep on going for a certain period of time. And then when it drops below that moving average, we'll exit that stock or we'll go short. Okay, so if the stock allows short selling, we can go short. So depending on, so this is a very important point, depending on stocks criteria, so you can go short in FNO stocks, you can either short sell in intraday, or either you can like take short position in futures and take it for longer horizons. Okay, on the stocks that are not in FNO and on non-indexes, I don't think like you can carry your shorts for longer than a day. You are forced to do intradays, and that's it. Depending on your broker, depending on the country you live in, depending on the regulations, and depending on features provided by your demat holder account, you have to adjust your trading style in that manner. So this is also a constraint that we need to follow while generating a hypothesis. So here we are looking at Nifty index, so we can go short as well as go long. We can buy futures, we can sell futures, and then we can also take short positions. So we can form a hypothesis that whenever the spot price of Nifty crosses the EMA line on a positive side, we'll go for long, and whenever it crosses below, we'll go short. So let me note down our hypothesis. Okay, I'm making some typos, but you are getting the point, that's the main thing. Okay, so I have written whatever I said. So the thing is that, what spot price do we take? Do we take last traded price? Do we take open? Do we take high? Or do we take low price? So for here, we'll take the last traded price. So just in bracket, I'll put LTP. So these are the things, granular things, that we'll have to decide whenever we are kind of doing the back testing. And they are not kind of like a very hard and fast rule that you have only to take that high price, only have to take the close price or last traded price, or not the high price or the low price. You can take whatever. The end goal has to be clear. The end goal is the only thing, that the strategy should perform consistently over a given period of time for a particular set of selected universe. Okay, so keeping that in mind, the details, the granular details, that may change, that may fluctuate, but it has to adhere with the the performance matrices. Okay, we'll talk about performance matrices later in this webinar, or if it goes long, we'll cover it up in another webinar next week. Okay. So we have formulated our hypothesis, we have selected our universe, so also note it down. Also noting now the time frame. Okay, So coming for, yeah, we have formulated the hypothesis and we are going to select our look back period. So how much time are we going to look back for? So it depends on the ease of data collection. So can we get the data all the way from 1996? If yes, then it will be well and good. If we can get the data for last 10 years, we'll use the last 10 years data. Or if we can get the data only for 1 year, then we'll be forced to use just 1 year. Okay. So when we are like kind of like using this daily data, and these are kind of like, these parameters are kind of interrelated. If you want to like backtest for all the way up to 1996 or 2000, then you have to go for daily data, because paying for 1 minute data will be too high. And yeah, if you can afford that one, that is well and good. You are invited to like purchase that data, and also you can share with me if you want. I'll also use that data. If you do not want to spend on data, if you want to spend minimally on data, then you have to look for the cheap sources of data or free sources of data. You can go for NSC site for some data. You can go for Yahoo Finance, that contains a good amount of data, and we'll see in this video how we can fetch the data from Yahoo Finance. Okay, so let's say like we want to backtest it for last 5 years. So we'll be able to get this data. So let's see further. So once you have these parameters for our testing, backtesting, we have to finalize the metrics. Okay. So how do we gauge our strategy? Do we gauge our strategy only on P&L that it generates over historical period? Do we gauge our strategy on volatility it gives? Do we gauge our strategy on drawdown, that how much money has it lost while underperforming in the market? So how do we gauge our strategy? So there are many matrices, portfolio strategy comparing matrices. You can look out for Sharpe ratio, you can look out for Sortino ratio, you can look out for Kalman ratio, but I'm not going to discuss. I'll leave it up to you to Google it out. Okay, these are quite easy to understand, and in case you have any doubt, you can get back to us. You can either comment it out or you can reach out to us. Now we are kind of like, so for this testing, we'll go for just P&L, profit and loss, that one unit of stock, buying 1 unit of stocks would have given over a period of time. Okay, so let's say like we started 5 years back in 2017. So today is 2022. 2017, from 2017, how much would we have gained if we could have purchased one stock and sold one unit? Okay? So this is kind of hypothetical. In futures market, you are not going to just control one unit, you are going to control one lot size. But this is kind of like testing. So for indicative performance, we will take 1 unit of script. So we will take 1 unit of Nifty. Okay, we have this kind of sign in requirements again and again. Okay, so I'll just keep on refreshing it. Yeah, so we get our EMA. So let's go 5 years back. Yeah, so here we are 5 years back, starting from 2017. Okay, so if we have started in 2017 Jan, okay, So this is the price point. We have the OHLC data, that is open is 8210. You can see it here in the top section. We have the data point for wherever we hover our cursor. Okay. So on 2nd of Jan 2017, we have open as 8210.10, high, low, close, and the difference and the performance of that day. That day, like the stock, the script or the Nifty index went down by 0.08% or negative 6.30 points. But as you can see, we have our moving average line at 8098.58. Okay. So this is kind of above the moving average, and our hypothesis says that if we are above our EMA line, if the close price, so the close price is 8179.50. If it is above the EMA line, we are going long, and if it drops below, we are going short. So as we are just starting out, we are not having any position to cancel it and go reverse, so we will start a fresh position. So we'll start, so just kind of like dry running. So this is kind of like whenever you are going for backtesting, you can have a bit of dry running to predict what kind of like complication or what kind of like errors you are going to face while doing the actual backtesting, either like you can do in Excel or whatever, like you can do in Python. Yeah, we'll come to that on later part, but let's see what happens here while dry running, while visual inspection. So we have entered at 8179. We went all the way up to here. So let's go with the dates. Let's go with the dates. So on 20th Jan 2017, okay, our close price is 8349.35 and EME is 8366.01. So this is the day when the close price finally breached the EMA line. Okay. So as per our hypothesis, we have to cancel out our long position and we have to enter a short position. Because yes, in Nifty we are in future, we are assuming that we will be trading in futures, and as per like we can go short by utilizing futures, and Nifty does have futures. We'll go short, but again, if you can see, just the very next day, our close price is 8391.50 and our EMA is 8371.11. So yeah, we have been stepped out and we are again forced to close this position, that short position, and go for long position. So again we'll go trading. So this is the point where you can see the open, okay, 8570.35 and EMA is 8557.59. So we are safe. We are neither of our low is kind of like breaching, but yeah, as per our condition, we are tracking the close. Close is 8716 and EMA is 8557. So yeah, we are safe here. We have not yet exited. Again, we have exited on 15th Feb. So this is this is basically the strategy, and this I want to trade it. I want to like test it quantitatively. Okay. So this is visual inspection, and I want to like get what kind of like profit and loss I would have generated if I would have followed this strategy from 2017 to 2022 or last traded date. I can do this visually for the entire period of 5 years, but that's too tiring. Okay. I got tired in just 1 month, and I do not have patience or energy to go all the way up to 2022. For this purpose, we will do a proper backtesting. Okay. So backtesting you can do in Excel also. You can do in Python also. You can do in MetaTrader also, that's kind of like a dedicated software for like algo trading. And there are also like many third party softwares apart from MetaTrader. You can use AmiBroker or whatever you, there are many kind of like softwares. And one more interesting fact is that you can do it here itself in TradingView panel itself. You can go for like Pine Editor, so it will have some kind of like some of their own language where you can specify the entry and exit condition. You can like run the cell and then it will give you the performance. So we'll discuss these steps, but for this we'll go about collecting the data for Excel and for Python. Okay. Once we are done with Excel and Python, we also come for Pine Editor, and then we'll see what are kind of like performance matrices that are there. So what if we want to optimize? So after backtesting, let's say like we got some profits of couple of hundreds of points. What if we are not satisfied with it? What if I know that this hypothesis can generate like good amount of profit, but it's not living up to full potential? When this happens, we will then go for optimizing the parameters of our hypothesis. So our hypothesis only says that EMA, exponential moving average, not the parameters of what parameter of moving average are we taking. Okay? So this is kind of a variable. So if you know a bit about programming, you must be knowing that a variable is any kind of like object that can change its value. Okay. Here in this EMA, in place of 9, I can increase its value. Yeah. So if I have 30 EMA, you can see that we have entered on the date of second Jan, and we could have gone all the way up to, yeah, 27th June without exiting our trade. So our close price on 27th June is 9511.40, and our entry price on 2nd of Jan is 8179. So it's almost like more than 1,000 point difference. Okay. So this is what will happen when you start optimizing your parameters for whatever the hypothesis that you have chosen. For this hypothesis, you can add as many indicators as possible, as many parameters as possible, but you need to optimize it in order to get that spot, okay, that maximum profit. And one thing of caution, that historical performance doesn't guarantee future performance itself. Okay. So if I take you again back to 2022. Okay. So in this chart you can see that what kind of performance are we getting. So the trend last very so the trend doesn't last very long in this kind of situation. So yes, if we have like tested on the data of 2017, the parameters would be like very brilliant. Okay, this is going to give me some trade benefits of like 1,000 point on a single trade. But the thing is that in 2022, it is going to like step you out every month or every 15 days or so. So this is what you have to take care, that when you are fitting your parameters. So basically what we did was we fit our parameters. So it was, so the previous parameter of EMA as 9 was removing us from trade and giving us false signals, giving us spurious trades that would be exited just by giving a very small amount of profit or just by giving some amount of losses in couple of days or couple of sessions. So we increase the parameter value and we fit it on that curve. Now when we fit on that curve, it got adjusted to that kind of like chart and not on chart that came afterwards. Okay, so we have enough of talking. Now let's start some data collection. We will go for Yahoo Finance. So if you want to collect the data in Python, you have we already have one video on that one on our channel. You can go and check it out. It is of getting the data from Yahoo Finance itself in Python or in Jupyter Notebook. Okay. We'll search for Nifty 50 and we have this tab of historical data. Okay. So we can also specify the time period for which we want the data. Okay. So I'll just specify for 5 years and the date has changed for 24th of July 2017 till 24th of July 2022. I'll apply it and I'll download it. Okay, so now we have data downloaded. So we'll first do a visual inspection of what kind of like data do we have. We'll just open it, and whenever like we are going for like some kind of like technical improvement, we just have to do some visual inspection before everything. Okay. So it might give you some insights. It is also like some kind of like exploratory data analysis that is a fancy term. So in that we can like do much more than just visual inspection. We can do for like what are the kind of like statistical properties of this data. We can go for mean, median, skew, what is the kind of average returns that is given by this Nifty, and then we will do in data part. Okay. So as you can see, we started from 24th of July 2017 and we have open, high, low, close, adjusted close and volume. Okay. So adjusted close is the data that has been adjusted to all the dividends, any splits or any kind of like stock announcements. So this is mostly used for like stock data. So whenever the stock would have splitted as 1:3, then the stock price would directly drop from like let's say 900 to 300, and that would like create some bump in our trading strategy. Okay. So to prevent that kind of like things from happening, we generally use adjusted close data. But this is kind of like the index data, so we will just use OHLC data. Okay. So I don't know like why there is a volume for an index, but generally we don't have any volume for index. Index is not traded actually. The underlying of index is traded. So we have got the data. I'll just delete it out. We have the data till okay, yeah. So just we found something that needs to be taken care of. On 1st of Jan 2018 we have the null values. Okay. So whenever like you are performing some mathematical calculation using some software as Excel or Python, you have to take care for this null values. In Python it will give you NA values, NaN values. So these will hinder your calculation. It might give you some errors, it might give you some spurious results. So first of all you have to take care of these things. So there is kind of like you can filter it out, you can like delete it out, but you have to take care of it. And for the same reason I just like went for like a preliminary visual inspection, that if we can find something we'll go for it. We have this null value in 2018 on 1st Jan. So if we can find one, then maybe there's a good chance that there are other null values as well. So I'll quickly go for to I'll filter it out. Okay. So finally we have 4 null values and we'll just remove it. So as you can see, like we have removed the null values and now our data is clean. So maybe like some more data issues may arise, but we have taken care of the null values. There may be some like results as 0000, which is not possible for a continuous trading system. But if we encounter that one, we will take care of it at that point of time. Or let's say like we can search it now itself. So as we know, this can happen. So let's take a precaution. Okay, let me just sort it out. Okay, so there are no zero values, so we are quite confident that this is not going to happen. Okay, so our signal was EMA 9 and EMA 30. Okay, these are our two signals. So we'll form a signal. Okay. So once we have this EMA signal, so we can do complete backtesting in Excel itself. We can like as we have previously discussed that we are going to generate P&L statement and we are going to use P&L as our metrics of our strategy. So whatever the profit and losses that has been generated over past periods of data, we'll take that as a parameter to gauge our strategy. Okay, so we'll be comparing couple of values of EMA, exponential moving average, and then we are going to gauge that what kind of like parameters are we going to move forward in case we are going to move forward. Okay, so let's say like out of 9, 12, 18 or 30 parameters of exponential moving average, 18 is giving good and consistent result. So if we are going into market, we'll choose 18 as our indicator parameter for EMA. Okay. So let me take this to Python and then we can like take it out. I'll just delete it out here. Save this one. Okay, so we finally came to the point where we can directly start our backtesting. We can directly go to our coding terminal and we can start coding out the signal, comparing the parameters, comparing the close price, and then storing the results. Okay, so as of today, we'll end our webinar on this one because I need you to grasp this information, and on the upcoming week we'll go for final coding and performance of the strategy. Till that time, if you have any question on these parameters, you can reach out to us, you can comment it down below, and then we can go for, once you are cleared out with that one, we can go for final backtesting. We'll continue the same problem. We'll go for like calculation of EMA in Excel, we'll go for calculation of EMA in Python as well, and then we'll be generating our reports. We'll also be optimizing, we'll be using some kind of like solver in Excel, we'll be using loop functions in Python, and then we'll be like getting out the best parameters. Okay, going further, we'll also be making our strategy more complex using multiple indicators and multiple parameters, so that we can find the optimum strategy so as to generate some profit and cover our broking and commission expenses. So that's it for this webinar. Thank you very much for being with me.